Hey, everybody, welcome. Thank you for being patient for the last couple minutes as we're trying to make sure that everything tech was ready for you and ready to go. Make sure you just give you this good, powerful power pack thing. So definitely, as you guys are popping in, I know a lot of people from the live feed from YouTube or Facebook. Say hello, say where you're calling from. You're not calling, wherever you're tuning in from. Be sure to say hi to us for sure. Definitely excited today because this really what we're going to talk about today is how can you beat the banks, right? I mean, that's really what this is about is how do we really get ahead of this? How do we beat the banks? So I'm going to go through this because I'm actually going to get technical. Even if you've watched some of these kind of similar presentations before, I've added more content just to even add it. So even if you're one of our clients, you've been around for a while, you've been tuning in for quite a bit, the podcast, or you've watched some of these other master classes, I want to throw in some things that might kind of intrigue you, or even and just kind of give you a little bit more that you need. Because the truth is that even though banks are paying better than they've paid in over a decade, really it's about the best it's been in nearly 20 years. I remember in 2005 seeing interest rates at savings accounts being like 5%. But right now, it's temporary. In fact, the Feds just came out saying they will cut rates this year, which means that you will see a decline in how much money you're earning at the bank. Not to mention, are the banks really that safe? Are we really in a good place? And so I'm going to talk about how to beat the banks by saving where they do. How do you cut out the middleman, right? Because the banks, they're just paying you whatever. They're going to keep their profits. They're going to keep their cut. But could you invest in some things that like they're doing, but even do it better? And that's what we'll talk about here today. So I'm going to show you how you can actually store your money where it's better returns than the bank consistently, despite whatever the Feds will do. It's safer than the banks and definitely safer than the stock market. Tax-free, guaranteed. It will protect your family even if you're not around. It also is sheltered from sue-happy predators and creditors. So if you get sued, that money is safe. That's not the case in the bank, but here we can keep it sheltered away from those sue-happy jerks that are out there, especially if you're in the US. That's pretty much a lot of people. You live in California, I mean, man, sorry. So anyways, it's bad. And also, this is something that can also give you a passive income booster that will pay you twice, shaving years off your financial goals, just like hundreds of my clients and I have already done over these last few decades. So if that's something you want to see, then keep tuning in. Now, who's this strategy not going to be for? This is not for somebody that obviously doesn't have money in savings. If you don't have money in savings, I recommend, doing like our cash flow secrets class or something like that, where you can actually find ways to free up cash so you can start saving. So if you can't at least save $5,000 a year, $10,000 a year, the strategy really is kind of a moot point, right? Because we're not really, we're talking about saving. So if you're not saving, this is not going to apply. Also, if you're in your 70s or 80s, this may or may not apply as much to you, although it can still work. It's going to be a little bit different strategy than what I'm talking about today. Also, if you're in horrible health, and I mean like just about like deathbed health, if it's like that, this is also a strategy that may not work for you personally, but it could work for somebody that's in your family, could be a business partner or somebody else, where you could still use it, but again, using somebody else who might be in a better health situation. So that's what we're talking about today. Now, there's a lot of challenges we're dealing with right now, right? We hear about talks of recession, which even then the recession hasn't really done much. I mean, we've got that situation going on. We've got government debt being run up like crazy right now. Now with over $34 trillion of debt, to the point where now with these higher interest rates, now there's government pressure on the Fed to say, I hope you lower rates because we're going broke fast, right? We can't keep up with the payments. Also, we got the interest rates going crazy for you, right? Where that's not even fun anymore. So it's not fun at all. We got banks that we don't know what's going to happen with them, right? How secure are they really? It seemed weird that there was like 3 bank failures last year, about a year ago in March, and then all of a sudden it went quiet with the banks, supposedly. But that talk is happening again. There's more bank failures that keep getting announced over and over and over again because of all these interest rates that just went up too high, too fast. The banks couldn't keep enough reserves on hand, and they're suffering right now, especially the smaller regional banks, credit unions, banks like that. They're suffering right now. The bigger banks are kind of licking their chops that they want to be able to gobble them up. But even then, it's just such an uncertain world that we know, because how many more banks are going to fail? And do you trust keeping your money in that place? How do you know that your money is going to be safe? Because in the last depression, it wasn't the case, right? And I'm just going to tell you the strategies that we're talking about today, guys like Dave Ramsey and some of the traditional, people that just really just spew out the same old crap you've heard for decades, which still hasn't got people free anyways. They just don't get the strategy. They don't want to understand it, and they don't care to understand it because they got their thing. But people that have understood it, we got guys like Walt Disney used it to create the happiest place on earth, right? We've got him that's done that. We've got guys like Ray Kroc. When he bought from the McDonald's brothers, he didn't actually take a paycheck for 8 years, but he actually used a strategy to be able to pay not only his key employees and executives to stay on board, but also the branding that you know about McDonald's today came from how he used the strategy. And so, what tools have allowed all these iconic figures to make millions at exactly the right time, which is the time that I'm seeing is kind of like right now. And where the banks are also storing a good chunk of their money. And by the way, it's not just me. There's stats out there that show this, that a lot of them are keeping at least 10 to 20% of their cash in this same place. It's this infinite banking. Now, even if you heard me talk about infinite banking before, like I said, I'm going to go a bit deeper this time than I have in the past, right? I'm going to sit on the strategy a little bit so that you understand how this really works. Now, this doesn't mean you create your own bank, right? You're not literally creating a bank or going through that whole process, but it's a strategy you can use that works like a supercharged tax-free savings account. And the great thing is you can use it just as much as a bank. Well, okay, not exactly. Banks will use it for other things, but you can have better abilities with the banks too in some ways. Just so you know, I've had Eddie Wilson, a very popular entrepreneur. He was on my podcast last year, talked about how his grandfather had actually been using this and taught him this strategy. His grandfather was a president in a bank, and he actually used this strategy for them too. By the way, the smaller the banks, the more they even do this strategy. Investors and business owners use this strategy as well. I had one of my clients on, Jay and Krista, Jay Jorgensen and Krista. I had them on. He was a dentist, now recently retired. So he's enough passive income now that they're retired at this point. And one of these strategies, we looked at it, and even though he had done it with another guy that did infinite banking, still we were able to do it better. And I don't mean by a little bit, guys. I mean like $2.25 million over the next 20 years. And they get to have a bigger legacy they can pass on. $2.25 million. Can you imagine how much more investing they could do just by saving that much money? It's huge. As Danielle said in the comments here, definitely other questions along the way, ask them. We will address these at the end here for sure. Now, I'll say this too. I haven't mentioned this before, but in the last Great Depression, right, 1929, banks failed like crazy. There were over 35,000 banks in 1929. By 1935, they had whittled down to 13,000. Guys, about 2/3 of banks failed during the last depression. One of those people affected is a guy that you may or may not recognize right here, which is named James Cash Penney, also known as J.C. Penney. Now, J.C. Penney here, he had a store. He started in the early 1900s. He was getting to be a pretty big deal. He had over 1,400 stores by this point. And all of a sudden, where they were storing money in the banks, it failed. He couldn't pay his people anymore. He didn't know what to do. He went to this one place, right? He went to the one place, which is infinite banking, right? Now, of course, that helped build them out of the depression. Now, after 2020 COVID, they're closing, right? They basically filed for bankruptcy. But this guy made it. I mean, okay, he's dead now, but his company made it over an entire century in business, all because he had this infinite banking in place. That's the thing that was safe because that money wasn't at risk. All the banks were basically lock up the money and there was a total freeze. This did not happen to him because of this very purpose. Just so you know, there's a lot more people than just me saving up cash right now. Warren Buffett, he's got now $167.6 billion. That's $1 billion sitting on the sidelines right now. There's also an article that came out recently that over $6.35 trillion is sitting in cash on the sidelines in money market accounts alone. That's not including savings accounts, just money market accounts. $6.35 trillion sitting on the sidelines. Why? Well, because even though the stock market is going up, it hasn't gone up nearly as much as people like, while at the same time, these rates have gone up. So people are saying, hey, I don't know what's going to happen in the stock market. It could crash anytime. I'm going to throw it in these money markets. But what happens when the rates start coming back down again? Where's the money going to flow? And so my challenge to you is to unbank yourself. Get yourself away from these banks because let's be honest, guys, the banks, I can't trust them. Now, I still keep a little bit of money in the bank, but I'll show you where I keep the bulk of my money to keep it safer than what I could do with the bank. And this is we'd like to refer our strategy as max ROI infinite banking, which is using high cash value whole life insurance. Now, you've probably heard of death insurance, right? Like term insurance, you buy that for like 10, 20, 30 years. It's nice and cheap, but it just covers you when you die. So you never get any benefit from it. It's not really life insurance, it's death insurance. But here with whole life insurance, it's the standard boring thing that's been used for decades. I mean, some people have argued it's been around for centuries, and that's true. But this strategy especially got more popular even in the last decades. Like I mentioned with Walt Disney, even J.C. Penney, these guys used it even back then to help finance and fund their dreams, or even just to bail themselves out as for those emergencies. And so this strategy we're using, just plain boring, unsexy whole life insurance, but it's different because not all infinite banking is made the same, despite what you might have read or seen on YouTube. Because I know it's a trending topic right now. The thing is, most of the way things are done suck, okay, or they're just okay. They're good, but they're not great. And it's sad that I've had to say that to a lot of people that say, "Hey, I've got one of these. How does it look?" Well, you've got it. And some of them you can undo it. In some cases, yeah, I mean, we wouldn't do anything with it, but you kind of wasted tens of thousands of dollars on this thing that you could have done better if we could go in a time machine and go back in time. So this is serious, guys. Like what we're talking about is a big deal. And the reason I know this because, if you know my story, I used to be a financial advisor over 20 years ago. Did that for several years. But then after a while, I realized, especially with my own father, when he couldn't retire, even though he paid off all his debt, stuffed money in his 401ks, yet it wasn't enough. I realized something was wrong in this industry, this financial industry. Really, I realized I was a financial salesperson in a suit. So in 2006, I left being a financial advisor. I vowed never to do it again. I actually went into real estate investing. Now, as I was starting to do that before I was able to get myself financially free that year, I was actually talking with different people in the real estate space, and they all said, "Chris, you got to check out this infinite banking thing they all talk about." I said, "I've never heard of it. I've been a financial advisor for 4 years, never heard of this infinite banking thing." They said, "You should check it out." So I did. And I bought that Nelson Nash book I showed you a picture of just a little bit earlier, and I read it. I thought, okay, cool. I'd never heard of this before, but it sounds awesome. So I go to get the policy, and the agent, the guy that was my friend that set it up for me, said, "Here you go. Here's what it looks like." And I said, "Okay, cool. But this is really expensive. This is not just like more expensive than term insurance. This is more expensive than the stuff that I used to sell as a financial advisor. Is there a way I can make this more cash rich, up front?" And the advisor, the insurance agent said, "No, Chris, you can't. If you do, you'll get taxed on it." I said, "Okay, well, then I won't do it." Well, a couple years later, the recession hits. I find myself in a cash crunch. However, unlike guys like Walt Disney or guys like J.C. Penney, or even guys like Ray Kroc, right? With McDonald's, unlike all those guys where they had cash in it already, I didn't, because the first few years was all paying the insurance fees, right? All the insurance costs that come out because it's front loaded. It's more expensive up front, and it gets cheaper over time. And so I was paying all those insurance costs up front, which also, by the way, pay the agent's commissions. I was paying that all up front. So by the time 2008 came around, I have no money in there. I paid 25 grand into it. I could not afford to keep that policy, and I lost it. So that 25 grand lost, gone forever. Yes, I was covered with, $1.5 million or $2 million of life insurance for a few years, but that was it. I mean, that's like the biggest waste of money ever. Now, here's the thing. A few months later, I start researching it myself. Because remember, I was a financial advisor. I still kept my insurance license. I've been insurance licensed now for 22 years. And so I started doing my own research. I found out that guy lied to me. And so I sat him down. I ran my own numbers. I sat down in our office and I said, let's hash this out. And so he started debating me about why you shouldn't have, more cash up front, why you should have a higher death benefit. And so I even matched his death benefit and still gave people cash up front so that in my case, I wouldn't have lost my policy. And by the time it was all said and done, we argued for about 2 hours. And finally, when it was said and done, he said, "Chris, I did it this way because I couldn't afford to cut my commissions." And I said, "That's the kind of BS that I expected. That's at least honest. It's an honest answer, but what a bunch of crock. I'm not sending you any more referrals." And so I stopped. I started for really it's been now the last 15 years, finding ways to perfect this strategy and make it better. And sadly enough, even though I've partnered with different people to help me do this strategy, it always came back to the same exact problem. They all wanted to make more money in commissions. And so they wouldn't give me or my clients the best deal. They wouldn't get it to where you got the best ROI possible. That pissed me off. And so I kind of made my mission, especially in 2017. I said, you know what? We're bringing this in house. If we can't find somebody to do this consistently and do it the right way, what's right for the clients, and come from a place of abundance rather than worrying about their stupid pocketbooks. And the truth is, I was already financially independent by 2017. I didn't give a crap. So I didn't need the money. And so we said, let's see if we can cut those insurance costs as low as we could possibly go while keeping it tax-free so that people can get the best ROI possible, which is why many times we call it not just max ROI infinite banking, but no BS infinite banking. Because one, we're actually going to show you the numbers up front. And by the way, just so you know, at the end, we'll actually give you an opportunity. You could actually book a call with one of our guys, Parker, to be able to see how this looks in your situation if you want to. Either way, if this is educational for you, even that's great too. But when we do it, one, we actually show you the numbers up front. So it's not like you have to go through the whole process of applying and then you find out the numbers aren't that great, but because you spent this whole time and possibly spending weeks applying, going through this long process, you just go for it anyways. It's a sales tactic that they use on you. So we don't do that. We say, hey, here's the numbers up front. We'll even send you the numbers. So even if people want to shop us around, we don't give a crap because we'll still beat it. In fact, one of my old friends in this industry, she's pretty popular in this space. Somebody else was looking at her policy, saw our stuff, said, hey, can you run numbers for me too to compare with what they had? And even though they were already approved to have that policy done, they realized they had more money with us. Funny enough, they go back to that agent and they said, hey, here's the numbers I got from somebody else. And she goes in this long story about, well, you don't want to do it that way, but hey, I'll run the numbers again. And look, it's better. So she comes back after they see our numbers. Then she comes back to try to compete with our numbers, still doesn't beat our numbers, but she says, well, this is better. You should still use me. And that person just said, bull. First off, why didn't you show me those best numbers in the first place? Why didn't you give me the best in the first place? And then secondly, it's still not that good. And you're still claiming that somehow yours are better, but I can see obviously it's better. And so that's the thing. Again, we don't do any funny, funky math. Like the numbers are plainly obvious. It's better for one. Two, we're going to show you the numbers. And then three, of course, we're going to make sure it's the best every single time. Okay. Now, let's talk about how this works and the different ways you can use it, because you could store money here, but there's some other cool things you can do to actually get your money to pay you twice with your investments. If you're doing investing, you can actually earn more money. I'm going to show you how that works. Now, first, just kind of go through this. One, it's tax-free now and later. So think of it like a Roth IRA. You know how you put in your after-tax dollars, when you get your paycheck, you pay your dollars in, it grows tax-free, comes out tax-free. Same thing here. But just like I said before, there's no stupid, even though it's protected from lawsuits and creditors, which you can't get with most savings or plans. It's safer than the bank and it's guaranteed to grow at a much better return than what you get in the bank. The cool thing is there's no stupid limits or penalties. So that whole 59.5 rule you have with your 401ks and your IRAs, you don't have that here. You can actually access that money within the first month. You can actually get to your money. Now, granted, within policy, right, some of the money is going to go out for paying for the insurance costs because it is an insurance policy. So again, like I said, those first few years, there's a net cost to it. But after about year 3 or 4, it has a net gain. It makes more money in interest than what it costs you in the insurance costs and becomes at this point really like a tax-free supercharged savings account. So it actually grows faster than what the bank can do. It's safer than the bank. And by the way, like I said, you can store millions safely because even if people sue you in most states, there are a few exceptions. In most states, if you get a collector, somebody where you owe them money, you end up maybe not going bankrupt, but you're in collections or something, they still can't access this money. It is protected. Even if you've got millions sitting in here, they can't get to it. If it's in the bank, they can get to it. No problem. They have no problem getting to your bank or your different types of mutual funds and things like that. They can get to that money, no problem. But here, they cannot. So that's one big thing right there. There's also bank leverage, which is a pretty cool thing as well. And of course, you can, like I said, have access to cash today. All right. Now, here's the ways I use this, as well as some of our clients too. Like I said, we've had hundreds of people use this strategy. One, and first and foremost, is that you can use it for an emergency fund or for your reserves. Now, my situation, my wife said, Chris, I want to keep at least 300,000. And that number just keeps going up every year. I swear it's inflation, but on my savings account. But she said, Chris, I want 300,000 sitting in a savings account that we don't touch. We don't invest. It's just there in case the world goes crazy again, especially like 2020 was, but worse. And I said, no problem. But here's the problem, hun. If I keep $300,000 in the bank, right, and I'm earning 0.1%, and yes, the savings account's still paying 0.1% right now. And I know there's high yield savings accounts. I still have those too. But I said, listen, if I keep the 300,000 in the 0.1% bank account, I make 300 bucks in a year. And then I get taxed on that 300 bucks. So really I walk away with like 200 bucks in interest that I make on that 300,000. Where if instead, not just investing it, because again, we don't want to invest it, it's our protection, right? I said, if instead I keep it here with my life insurance, I earmark the money that's already been in here. Instead of investing it, I keep it safe and just keep it liquid. Guess what? I'm earning right now 5.75% tax free dividends on this money. Yes, there's net costs coming out, but still, even after those, I still make about a 5% net tax free rate of return. Now, many people are telling me right now, they're like, well, Chris, I can get 5% in a money market right now. You can right now, but is that consistent? No, those things were almost zero just a few years ago. It's only recently that came up, and they're kind of topping off right now as the Fed said they're not going to raise rates anymore. That means money market rates probably won't go up at all. That means they're only going to start going back down again. With mine, they keep going up. They have actually been between 5.75 and 6.34 for the last 16 years. So it's been pretty much between really 5.25 and 6.33% consistently. Well, that's tax free as well. So the 5%, if I pay taxes on it, I net maybe 3.5%. Where here, tax free, I don't have any stupid tax forms to deal with. I still make over 5% a year tax free on that money. I still do better than the bank. And so I keep my money there. By the way, 5% on that 250,000 I earmark in my life insurance in that policy in the cash savings account they have there. Well, that 250,000 at 5% makes me 12,500 a year, right? Tax free versus 200 bucks a year after I've paid taxes, right? Big difference. So even just that alone just gives you a leg up. That just gives you more money that can later be used to invest and make more cash flow, more passive income, as we like to talk about. You can also use it as collateral. That's what Walt Disney did. Walt Disney, he went to the banks for he already did Disneyland, got a great kickoff with that, had a great PR. The park was making money. His eyes were now on the swamplands of Central Florida, right? He's looking at these swamplands and he's trying to buy it all secretly. Well, he's trying to get money from the bank. And the bank says, no, I know you had success in California, but don't want to give it to you. By the way, if you watch any documentary about this, you'll see that this is actually a true story. Well, he goes to them and says, listen, if I come back with some of the collateral where he used a little bit of his money, his equity from his home. And then two, he used the cash as collateral in his whole life insurance. He used that to say, if I have this as collateral, will you give me the loan? Will you give me the rest of the funding? And the bank said, yes, they gave him the funding. He was able to use that and make it work. And the rest is history. We got the happiest place on earth in Florida now, right? So for those of you that have been going to the parks, you can now say, dang, this is what it looks like, right? This is what it could look like. Yes, you probably won't build an amusement park, but I don't want to squash your dreams. But I'm just saying, there's a lot of cool things to be done there. I even had a client who used this as collateral to buy his building for his practice. He was in the health industry. He bought it. He had a building he wanted to buy. He was going to cash out his life insurance and just cancel it and use that cash to buy the building outright. But I told him to go to his bank, his local bank instead. And you know what they did? They gave him a mortgage that was over 2% less than the low rate that they were offering at that time. So they gave him an even lower rate because they said, well, we got the building as collateral and we got this cash as collateral. Awesome. We'll give you the money for it. And so they did. He got this dirt cheap payment. He built out the building because he got extra cash for building it out and then rented it out. The renter was already paying his mortgage payment for him. So a year and a half later, after that was all done, he went back to the bank. He said, listen, the building, I think there's enough equity in the building now. Can we take the lien off my life insurance? And they said, yes, but they kept the terms the same. Understand, even if he got a normal mortgage, he would have never been able to get those terms had he gone and done his initial strategy, trying to just cash out and cancel his policy. This he actually used as collateral and got the very terms, even better terms he was hoping for. You can use this extra retirement income. Many people talk about how you can use this as tax-free retirement, but you don't have to wait till you're 59 and a half to get it. You could actually retire earlier with this very strategy. You can also use it for kids' savings accounts. Many people are hating their 529 college savings plans right now because the rate of returns of the stock market haven't been great. Even when they are great, they aren't as good in the 529 plans. On top of that, what if the market goes down when your kid is in college? If you're in the market and you're exposed, you could possibly lose a whole years of tuition or more while your kid's going to college because it's gambled in the stock market. And then, of course, if your kid doesn't go to college or they get a full ride scholarship or they don't need the money, what do you do then, right? You got to use it somehow, and it has to be used for college, or they slap you with penalties and stuff. That's dumb. Here, people know they have full freedom and flexibility to use it. I have one client right now. He's actually been building up the cash for his sons to then use that to invest and buy real estate that cash flows. And then the real estate's what pays for the college instead. And then cash flowing investments kind of goes along with this hand in hand. I'll talk about this here and how that works, this double arbitrage concept. So you probably heard me say making money twice, right? Now I'm going to take a break here. If you guys, again, have any questions, type them in the comments. I'll be sure to answer these at the end. I'm actually, funny enough, because of how I'm viewing this now, I can actually see your questions along the way. But feel free to ask some questions if something I said up to this point hasn't made sense before I jump into this next topic. Because this one will blow your mind. All right. Even if you've seen this before, I think you might see a different angle where it might even blow your mind just a little bit more here. So we want to talk about how you get your money to pay you twice. This one thing I teach, because I just did a class earlier. What was it? Last week, I think it was, right? I did a master class on how to create passive income, right? And we talk about this all the time, investing in passive real estate and things like that to essentially become work optional. But here's the thing, guys, like that is the key for you to become financially free. If anybody ever tells you that this strategy will get you financially free, don't buy it for 1 second, okay? This by itself will not get you financially free. Because you're probably wondering, like, is there a downside to this, Chris? Like, yeah, I mentioned upfront costs is some of the slow, it means it takes a little bit more time for you to make that money back. If you're going to invest for at least 5 or 10 years, this is a good strategy. If you're not going to invest more than a couple years, then you probably don't need this one, right? At least not outside of needing a death benefit. But the big thing is that passive income can work irregardless of this. But if you had the opportunity that you knew that just by doing one little extra strategy or one little extra bit could even accelerate and get you to retire and get, or at least become work optional where you could retire an extra year or two earlier, would you do it? So here's how this works. All right. This is what kind of throws a little extra gasoline on the fire. Again, this by itself won't get you retired, but it sure will help if you're trying to do it earlier and faster. Now, remember, there's always two options when it comes to money. You either use cash out of your pocket to pay things in cash, or you borrow money from somebody else to pay for it. That's really your only two options, isn't it? You either use the money to pay for it yourself or you borrow it. And in both these options, you're always paying interest. Now, I know you probably understand that borrowing money, you're paying interest, but how is it that when you use cash, you're paying interest? Well, here's how. Let's say you have money in a savings account. Say you have $50,000. If you pull that money out, right? You pull out the 50,000 bucks out of the savings account and say you just hold it in cash. Guess what? You've now lost the ability to earn interest. Heck, even if you keep it in the savings account and making your point nothing percent or whatever you're making, right? Is there a better opportunity where you could be making more? So many of our clients understand. They say, well, man, we know we can get the money out of savings, not our emergency fund, but the money we use to invest instead, get that money out to invest somewhere else to make a higher return. But if we don't invest it, there's an opportunity cost because we're losing opportunity. We could be investing, say we could make 10% on a real estate deal, but instead we choose, making 1% or less potentially. Maybe you're making 2 or 3%. Maybe you're even making 5%, but you're still not making that 10%. You are paying interest because you lost the opportunity to earn interest when you hold money in cash. And heck, even if you just spend money in cash, if you go and buy a car outright in cash, that money can no longer be invested, can it? Because you just sunk it into a car. Same thing, you put money into a house. You put money into a house as a down payment. Now you got to do it to some point, but what if you put extra down payment that you didn't really need to do? Well, that's money that now cannot be invested. And no, I would not get a home equity line of credit to do that because that's more expensive than if you've just kept it out in your pocket anyways, right? So that's the thing. You're always paying interest. You just got to understand which one costs me less. Is it, the bank's money? If I borrow from the bank, is that going to cost me more than just use my own cash and what I could be doing with it instead? Or could use my cash be a better option or not, right? So here's the key concept you got to understand, that there's two different types of interest rates. There's compounding interest and there's simple interest, and they're not the same. Let me illustrate how that works. And by the way, even if you're just planning to invest and you're wondering about, hey, should I be using my home equity or not? This will answer that question for you. Again, I always tell you, I'm not giving investment recommendations. I also teach people to be a wise steward of their money and make sure they're not just pissing it away in something dumb, and gambling money like in Bitcoin and things like that. That's not what I'm talking about doing here. I'm just talking about simply what if you just, what's the difference between debt and savings, right? So say you have a $300,000 mortgage and it's at 6%. Well, this is the thing I used to teach as a mortgage broker. I used to tell people, I said, if you want to stick it back to the bank, pay off your house early. I'll tell you, those banks and mortgage companies loved me. Why? Because I told them to do exactly what the bank wants you to do. Yes, the banks know that they'll make interest off of you, but they also know that they want their money back faster. This is why they give you a better incentive, a better interest rate on a 15-year mortgage rather than a 30-year mortgage. If the myth that's out there that everybody talks about is true, that, oh no, the banks, they want you to be in debt to them forever. If that were really true, they would give you a lower interest rate on a longer term loan. Why? Because they know psychology. They know that you're not they know that you're not an idiot. You know that you want to pay less interest. So if they want to get you to do something, they lower the interest rate on a debt. Vice versa on savings. If they want you to do something with a savings account, they'll pay you more interest. That's why a lot of times you're seeing things like 6-month CDs. They don't want you to keep it there for 5 years forever at a higher rate. So they keep the rate lower on the 5-year and only put it at 6 months because they know that eventually these rates will drop and that they don't want to keep paying higher rates when the rates do drop, right? So they try to incentivize you by paying you more on savings, but they try to incentivize you on debt by having you pay less. So therefore, on a 30-year mortgage, over 30 years, I would show them this. I'd say, hey, look, this truth in lending statement says you're going to pay, if you pay the minimum payment, $347,000 of interest over the life of this mortgage. That means you pay more than double for that mortgage payment. You pay a total of $647,000 in payments over the next 30 years. So I tell them, stick it back to the bank by paying off faster. But here's the thing I didn't realize. What would that cost me if I try to pay extra? Now, if you pay a little bit extra every month to your mortgage, it does not save you that much in interest, despite what people try to sell you on that crap. It's not that big of a difference, really. I mean, it could be tens of thousands, no doubt. It might even be $100,000, but you're not really going to save a whole heck of a lot by paying an extra few bucks a month to your mortgage. The best scenario you have to save as much interest as possible on your mortgage is to pay cash for it. Now, follow along with me. Now, let's just say you do have $300,000 you can get your hands on. Maybe you cash out everything you possibly own to be able to pay off this $300,000 mortgage, but you've got it. So you try to pay that off, you will save $347,000 upfront over the next 30 years. But what if you had that same $300,000 and you didn't pay off your mortgage? What if you invested instead? What if you took that money out and then you used it somewhere else? Now, I'm going to have you guys type in here. I know there's a few of you on live. If you could type in on the comments, do this and start typing right away because it takes me a while to see it. But how much money do you think you would earn? So if it's 6% cost you $347,000 over 30 years, what do you think you can make on $300,000 in a 3% CD in 30 years? What do you think you'd make? Well, how much interest? If you're only earning 3%, half the interest rate, how much do you think you'd earn? Go ahead and type that in the chat here. I'm curious to see what you guys think. So you're not investing it. You're just saving it in the bank, right? I know it's kind of anti what I've been talking about here. Who's brave enough? I know there's always going to be that Wheel of Fortune person that says, I'm betting $1, right? So, all right, now as you're typing it, and I know that as you hit send and everything else, it's going to take a little time for me to see it, but here's the answer. 3% over 30 years, here's what you actually make in interest. $428,000 in interest. That's just interest only. That's not even including the $300,000 that's still there. $428,000 in interest at 3% over 30 years. You're probably thinking like, wait a minute, what? Because you just showed me, Chris, $347,000. How did I make, only earning half the interest rate, $85,000 more in 30 years? That's compound interest, guys. That's the difference. Compounding interest. See what happens, you already know this, right? You have $100,000 sitting in a savings account. If you earn 5% on it, the next year you have $105,000. But now you're not earning just 5% on 100,000 now, are you? You're now earning 5% on 105,000. So the next year you've got 110,000 and change. Then the next year you got 115,000 change. The next year you have like 121,000. Next year you have like 127,000, right? It just kind of keeps compounding and growing. It has that little curve that you always see, right? Where with simple interest on loans, it's the opposite, because as long as you're paying at least interest only, it doesn't compound against you. And by the way, there's no magic formula when people say, oh, you're getting ripped off in those first few years from banks. No, you're not. You are literally being charged just simple math interest. The only reason it's more is because, of course, the balance is higher, and they tell you here's the payment it will take for you to pay off in 30 years, right? But you could always pay more extra to it and pay it off sooner, of course. We all know that. But many people don't realize that it's not because the banks are ripping you off. It's just because the interest that's being charged, if it's at 6% and it's on 100,000, you pay 6,000 that year. But if you pay it down instead to 90,000 next year, now you're only paying 5,400 next year. If you pay down to 50,000, now you're only paying 3,000 in interest that year, right? It's just math. But that's the thing, the interest goes down with simple interest where compounding goes up. So the cool thing is, like I showed you, if you earned only half the interest in 30 years, you only earned 3%, you would still beat your 6% mortgage. You would still make more in interest than what it cost you. By the way, what if you earned the same interest rate, 6%, 1.423 million, guys? Guys, that's almost 1.1 million more than the interest you paid. Do you think I care about paying my crappy little 340,000 interest or whatever it is, 320,000, 340,000 of interest? Do you think I really care about that if I can make 1.4 million by earning just the same interest rate? No. 10% is almost 5 million. And then if I earn even 15%, which I've done that on real estate quite often, and even more sometimes, it's almost $20 million in 30 years. It sounds too good to be true, but guys, it's not. Because one, inflation is going to make 20 million not seem as much in 30 years. That's one problem. But two, there's people that have actually done it. They do it all the time, right? Especially us in real estate. We do it all the time, even for passive investors. Now, I'm not saying it's guaranteed, but guys, do you really care about paying that weaselly little $300,000 in interest if you can make 10, 5, 10, $20 million in interest? No, that's called an investment. That's the power of compounding interest. If you understand that, you'll also understand why, even if the loan rate is a little bit higher than what you're earning in interest on the loan, which is not much higher, by the way, you still make money. Here's how it works. Here's how you get that double dip effect. Most people just take money and they invest it. And then they take the cash flow from that investment and it goes right back in their savings account to build up again. And eventually, as they build up the savings, they go and they reinvest it again, right? That's kind of typically how it works. But if we use the whole life policy, if you use this instead of a savings account, right? You put the money in the policy and then you get a loan from the insurance company. You can get it from banks, like I mentioned before, but right now banks are charging more. So the insurance companies are cheaper. You can get a loan from the insurance company at a cheaper rate than what you get from banks right now. You can go and invest that money or use it however you want. You can blow it in Vegas. Just don't do that, please, because that's a bad idea. Bad stewardship, right? But you can actually use that money to invest and use however you want. So here's the cool thing, though, is that the money is still in your life insurance account. The cash savings that's in there is still there. You didn't pull it out. You do have the option. You could withdraw the money. But remember, if you withdraw the money out of your account, now you've created that opportunity cost because now it's not there earning inside the policy anymore. Yes, you pay cash for it. You don't have a loan against it. But now here's the problem. If you use cash, you're not earning interest from the company because here's what happens. They're still paying you 5+% interest per year. By the way, every year it keeps going up. Some of these companies are now already over 6%, if not this year, by next year, most of these companies are all going to be hitting right about 6% or higher in tax-free dividends. So if you don't cash your money out, instead you're just getting this line of credit from the insurance company because they're using your cash as collateral, right? Just like Walt Disney did. They're using the cash as collateral. They didn't pull the money out. They just said, hey, you got cash there, lock it away. We'll make sure you don't access it. But we'll give you the loan until that loan's paid off. Then you can access the cash. Same thing here. It's just like a home equity line of credit. But the difference is here is that it's like your home equity line of credit paying you interest while you still pay them interest. Many people say, well, Chris, why would I pay money? Why would I pay interest for my own money? That's the cool thing. You're not. What you're actually doing is you're actually getting a line of credit from the insurance company. They are lending you their money while your money's still sitting there. So as an example, say you have 100,000 in there. You want to, instead of pulling out 50,000, you borrow 50,000 from the insurance company. Your 100,000 still earns those tax-free compounding interest while you're paying them simple interest. You're paying them the interest that we want to be paying while earning the interest you want to be paying. And you can still invest it and make money there too. So give you an example. Let's just say you're looking to buy a property. This is a $30,000 down payment. You would get a loan from the insurance company for that $30,000. You buy your investment. And let's just say the cash flow on that investment is paying you $3,000 a year. Well, that cash flow, instead of just taking it, I mean, you could just take your cash and that's fine, but instead you'll take that to pay towards a line of credit. Now, one important thing to understand, this loan that you get from the insurance company, it's not on your credit report. This is a private loan with them only. And even better, there's no minimum monthly payment. You can pay back the loan, however, whenever you want. The deadline to paying it back is your death. And what do? They take out your death benefit and then pay the rest of your family tax free. So the great thing is that you don't have to pay payments on this. Where home equity line of credit, you would have to pay monthly payments. Credit card, you have to pay monthly payments, right? You don't have to do that here. It does charge you interest, but you're not required to pay payments. So the cool thing is you take that cash flow, that 3,000 a year, pay down the loan, that brings the loan down balance down a little bit at a time to the point where you get charged less and less in interest, while at the same time you're compounding more and more interest. And even though there might be a spread, there might be a slight spread of like a 0.5%, 2/3%, or more. It can even be more sometimes, but say it's only like 2/3%, you still end up out earning the interest you're paying because that's compounding while you're only paying simple interest on the other side. That's huge, guys. So let's use a real life example here. Say you have a small apartment that's $1 million. They require a $250,000 down payment. Now you could either use savings or you could use maybe your life insurance. Well, what if you did use savings? You cashed out the 250,000 and then you took the 2,500 a month to pay back in your savings account to build it back up again. How much would you earn over 9 years after you paid taxes? A whopping $1,200 of interest. If you're earning, I believe I did this at 0.1%. It might be 0.2%. I might have ran this at, but either way, it's point something percent, right? So, and by the way, most people, when they take their cash flow from their investments, they don't put it in savings. They keep it in checking when they earn 0%. They earn nothing. So they're just taking it and putting it there. So even if you did get 0.1% or so on your money, you only earned $1,200 in interest over 9 years, even though we paid back in 270,000 in cash flow over that period of time. But if I did the same exact strategy using whole life, and then, by the way, I'm in my mid 40s, so people wonder, well, if I'm too old, no, you're not too old, even if you're in your 50s and 60s. I'm in my going into my late 40s here soon. So no, you're not too old. So I did the same thing for myself, right? I ran the same numbers for myself doing the same strategy. Here's what the difference. It wasn't $1,200. It was $126,000 difference. That's net after paying interest to the insurance company. Net, guys, that's net. Not gross. That's net. That's actually what I had extra after 9 years doing that same thing. I much rather have 126,000 rather than $1,200. I'd rather have 100 times that. That's why when I use this now, when people say, "Well, if I do this year one, it doesn't make sense." No, it doesn't. This is something that if you're going to invest for the next 5 or 10 years or longer, then you really start to see the magic behind it. So that's how you make money twice, guys. That's a huge, huge benefit for that right there. Okay, now next, I actually did a comparison. Like, what if you did use savings account? I want to use a more like a real life scenario, like one of our clients who had $250,000 that they had in savings, and we wanted to invest it. And I'll talk about how you fund this and how you fund it where it doesn't take away from your investing money. That's one big misconception that people have out there. Another big myth. Now here, I just showed that this person still they invested 250,000 while they're paying in 30,000 a year because they're saving 30,000 a year already. So 250,000 is already invested. Now on the savings side, you invest 250,000, you add 30, you make 10%, that's 25,000 a year, plus the 30,000 he saved. That then increases that 55,000, making 10%, gets it to from 25 to 30,500 after that first year. So I'm basically showing you like how if you just keep reinvesting your cash in savings, making a 10% return, that's what it can look like. But if I did the same strategy with whole life, now the first year, the cash flow is less. Hey, the first, even year two, right? 36,500 there, 35,000 on the other side. Because why? There were some net costs coming out of the life insurance. So you had less to invest. But despite that, look what happens. Eventually, even though it shows here about 112 on the left by using savings, on the right, 121,000 because you still had extra cash you could be investing with your life insurance at that point. So you actually have 9,000 more. You pretty much just shaved off a year towards becoming work optional. If you're trying to hit that 10,000 a month goal or 120,000 a year, you just did it a year sooner using this strategy versus just using your savings account. Now here's the thing, even how we compare to other people, right? There are, and thank you for putting that. If there's questions that are coming along, I know that can be hard. It makes it tough. Now it's hard for me to kind of see this. You might see this better on your screen, depending if you're on a phone or a laptop. But here, this person actually did a good job of their infinite banking policy, putting in 10,000 a year, but it wasn't the best. Look at year one. They've got about $6,800, but in ours, there's about 75 or 7,600. I can hardly see that, but It's in the 7,000s. Most of the time, by the way, it's usually between 7,500 and 8,000. But I was trying to do apples to apples here. You'll even notice later on, look, still after 10 years, you got thousands more, over 10,000, like $13,000 more money. And then down the road, even if you're comparing, I highlighted those things, still $100,000 more almost doing our method. By the way, this is the same company. So it's the same company, but again, different results. So it's not about the company, guys. It's about who is writing the policy, how the person designs it, the agent, the person that's the infinite banker. That's the thing. Now, I'll say I'm not an official infinite banking, IBC practitioner. We don't claim to be that because honestly, they don't do it as good as what you do anyways. So we really don't care. But we use infinite banking because that's what's more commonly known as. Now, some people have been asking me about index universal life, IULs, right? That's been a very hot question the last year or two. Why not? I'll tell you why. I actually used to love IULs in the mid 2000s. I actually offered them before they even got popular. I was selling them. But as I trained other insurance agents how they worked, I realized there were some risky things that maybe kind of question whether is you really could predict anything with it. Because one, for most part, there are a few exceptions. There's no double dip effect. So that whole compounding where you can borrow from it to make more interest, most of them just give you, at best 0% loans, but you don't earn any interest on the money that you've done. Also, costs go up every single year. That's one of the most dangerous things, that costs go up and there's no certainty. So if the market doesn't go up, maybe you have a couple bad years of the stock market. Yeah, you don't get a negative return in these index universal life because they're tied to the stock market, but you don't get the downs of the market, but you also don't get all the highs either. So it's kind of like this, you get this range of maybe like 0 to 9, maybe 10% if you're lucky. Well, if you get that floor, well, if costs are going up every year, you still have costs coming out. You could potentially actually lose money in those policies when the market's not performing well. So it's kind of a big if it can work. In a rare case, like if you got it in 2009 and you've had it till now, yeah, you'll probably have beat whole life if it was designed well. But for the most part, like where the market's at an all-time high right now, I definitely would not trust buying something when I don't expect the market to do a whole lot more in the next decade. So that's why I don't use IULs. And even the people that try to say, well, IULs are cheaper. No, we still beat them. So you still end up having more cash. It's more accessible cash you can actually use right now. And again, get that double dip effect. Here's reasons why I wanted to ask like other guys, some in real estate, some in business, why do you use it? I think these are some of our clients here. Neil, he said, I don't want exposure to bank risk. He's like, I want that creditor protection. If somebody sues me, I want that ability to have my money protected for my family. Ron, his big thing was he was trying to wonder last year, he was wondering where he could go to actually store large amounts of money. His banks, even though he was using large banks, they were treating him like crap. They were even paying him crap on interest and things like that. He's like, where else can I hold money? I told him, it was in a room. I said, Ron, you already know the answer. You already have one of these. And what did he do? Not only did he use that policy, but then he bought another one as well, just to be able to really diversify away from the banks. This guy's, they're a dentist, so in their case, they're like, man, I wish we had met you guys 20 years ago. I can't tell you how many times I've heard that. They're now teaching their kids the strategy, but they love the fact they have that, again, that ability to leverage their money, right, and get freedom from it. Dan, he's actually, in his 60s. He loves it because he gets that double dip effect, and it's tax free, of course. You get that, effect there. So this is the big thing, guys. I'm trying to teach you really how to unbank yourself. Get away from the banks. I don't trust the banks, and I don't trust FDIC. The FDIC insured thing that you always hear about, it's supposed to give you that warm, fuzzy feeling. Do you realize they only have about 1.5% of those reserves actually available? So imagine if somebody says, oh yeah, I got your back. Like, yeah, you want to invest your money with me? $100,000? Great. No problem. I got your back. Well, how much do you have in reserves in case you need to pay me back? Well, I got $1,500. Would you feel very confident investing with that person? They said, oh yeah, I'll make sure you get your money back. Well, how much do you have? $1,500. Okay. Well, that's not a lot of money in your own personal account. I want to make sure you have more money yourself. Even if it's not the full amount, give me more. That's the FDIC, guys. They're broke. They would have to scramble, and it's very possible that you would not be able to get your money if, say, even 10% of banks failed. Not even 2/3 like the Great Depression. Even just 10% could make a big impact and freak people out. Not to mention people start pulling out more and more money, and then you got to run on the banks and everything happens. I like to know that my money's safe. I can get to it. That's why I use this. Now, how do you fund this? This is the thing that's very important because there's Parker, who's on our team, that designs these policies. He's talking with a lady, and And she had another guy coaching her, talking about how you can use your home equity line of credit to invest and you're going to pay it down. Basically, same strategy with infinite banking, but with a expensive home equity line of credit. And he said, "Oh, you don't want to do infinite banking. It'll put you back 5 years from your cash flow passive income goals." And I said, "Well, that's a bunch of bull." Because why? Because in those first few years, when it has a net cost, guess what? We don't want you to use your investment money. In fact, I'd rather just have you keep investing your money. And this is what I tell all of our clients. You got 200,000 to invest. Great, invest 200,000. What do you have sitting in your emergency fund that we're not going to be investing? Oh, I've got $50,000. Well, great. What if we only did 20,000 a year? And you're still saving into that savings account too, right? Yeah, I'm still saving. Like, yeah, maybe I'm saving $1,000 a month. Okay, cool. So you're still saving $12,000 a year. You do that, you still got the next 3 or 4 years payments going for you. And in the meantime, you still made with that 200,000. Maybe you're making 10%, 20,000 a year. That's also paying for your policy. So the cool thing is, we actually don't take money from people that are trying to invest. That's the one key difference that we do compared to these other guys that say, throw all your money in here and then you invest it. Don't do that. The only reason they're telling you to do that is because it makes you buy a bigger death benefit and it rips you off in fees. Don't do that. We like to keep it more steady and stable where you put in a certain amount. And by the way, even if your max is $20,000 a year that you're putting in, your minimum's less. I had a woman who actually is in just average health, not great health, not perfect health, but decent health. She's about 50 years old. And I was showing her, I said, "Hey, on $20,000, you're only required to pay about $4,800. And that's even with her being a little bit older and having, not as perfect health. She had greater health. That might be closer to about 4,000 a year versus 4,800 a year. So you have a range you can do. So you're not required to have to pay in $20,000 a year, but you have the ability to pay up to that much. And so I tell people, use your emergency fund to start diversifying, right? Just like people do to start moving their money over to high yield savings accounts, do the same thing. Move the money over here over the first few years. And pretty soon when it's already making a net gain, a net profit, where you say you're paying in 20,000, but it grows by 21,000 in year 4, for example, or maybe more than that even. Great. Now it's already paying for itself. In fact, you don't have to, by the way, you don't have to pay into these forever. Unlike term insurance where you pay into it and then eventually you'll lose it. That doesn't happen here. Whole life, even though you could pay it your whole life, we design it to where usually you don't have to pay it your whole life at all. In fact, you're only required to pay in for up to 7 years. And even then, you're not even required to do the max amount. And it's already paying for itself, like I said, usually by the 4th year. So that's where you start, as you're putting the money in, then you start using that money to invest. So just like I did, I earmarked $250,000 in my savings account, in my whole life savings account there. I earmarked that money to not touch. That's liquid reserves for emergencies. But on the other side, anything else above that, free game to invest however I want. That's how you use it. And kind of like I've already mentioned before, guys, like this is kind of like the process you go through. Like you open up like it's max ROI infinite banking policy. You start to fund it with your emergency fund. As the cash then builds, you then, as it builds above that, you use the policy to invest for passive income, which also kind of helps you pay for the premium anyways, right? And then you use the cash flow from the investment to pay down the policy loans, which then allows you to be able to invest it faster because again, it's compounding interest at the same time, allows you to be able to reinvest this money faster. And then that just creates this, what I call this income avalanche. It just keeps repeating and repeating, and you become work optional faster. Now, here's a cool bonus. Anybody that wants to, you can actually have a free consult with Parker. And just to see if this works for you. Again, like if you don't have money to save, then don't do it. Like you don't need the consult, right? You already know that you just need to get to the point you start saving money. But if you already got money in savings, you're looking to maybe even diversify it somewhere safer than the bank and earn better than 0.nothing% at the bank, and even better than the varying rate that you might get from a money market account with a bank. Still, if you want something like that, you can actually set up a call with Parker for free. We don't charge for that call at all. By the way, we don't even charge technically for these plans. We don't have like a separate consulting fee or anything like that. We get paid from the insurance companies if you decide to do a policy with us. But if you do a policy with us, cool thing is we also give you access to our Wealth Accelerator Academy, which is actually all the financial education, all the investing education, the cash flow, even if you're trying to find out ways to find and free up cash, even tax saving strategies and things like that, debt pay down strategies, all that stuff we teach in that academy. You get that for free when you set up an infinite banking policy with us. So you get automatic, pretty much we have is lifetime access to that thing right there. In fact, this is kind of taking place over one of our monthly calls for the Wealth Accelerator Academy because we do monthly calls for people as well. So if you want to do that, I don't know if you can see it or not here, but if you can see the QR code, you can go ahead and scan that. or take a screenshot of it or whatever, and then try to scan it later. But definitely you can run numbers with our team. If you can't get this code to work, you can always just go to our website, moneyripples.com, and you can just book a call right there too. But we just want to try to make it as easy for you as possible. So at this point, let's see if there's any questions. I know there's a few of you on here. I know some of you guys are in the future. You're watching this recording later on, so I can't answer your questions there, but definitely put in the comments anything you've learned at this point. So anything you've learned, definitely put that in the comments. But if you have a question, kind of go deeper on this, let me know. The time is now yours. Let's see. Now, if I can see, and Danielle, if you can, if you want, if there is a direct web link, let's put that for the booking as well, if you've got that. All right, I'm going to allow for a few more minutes, just another minute for a question here, because I just realized I've got another call coming up. So I was try to cut this off here. All right. Well, anyways, guys, appreciate your time. If there's no questions, you can always put them in the comments. We will answer them later. It just won't be real time here like this is. But if you have questions for us, let us know. Again, you can always contact us at moneyripples.com. Guys, thank you so much for tuning in, and we'll talk to you later.